There's a well-known analyst in the SoFi community who's made one of the boldest trades in fintech. He went short SoFi and long Lending Club. And if you've been following SoFi for a while, you know exactly who I'm talking about. And now we got updated earnings for Q1 for both of these companies. We got new guidance, and we also got a very different story for what the growth profile looks like for both of these companies. And I wanted to put together a quick video to walk you through the updated timeline of this trade, the original logic, the actual financials, and ultimately what happened in this trade. I talked about this in December, and I want to provide a little status update right now because to this day, as recently as last week, there are still analysts coming out with short reports on SoFi and with sell ratings on SoFi. So let's jump right in. So, of course, the sell report that I'm coming out with is the fact that 8 days ago, KBW analyst Tim Switzer stuck to their sell report for SoFi Technologies. And Switzer had a very similar stance to David Cavarini, which was the analyst for Wedbush. Now, Cavarini essentially in May of 2023 initiated a sell rating on SoFi with a buy rating on Lending Club. And he talked about a paired trade. At that time, SoFi was trading for just above $4.50, which was the actual bottom of SoFi. So near the bottom, he said SoFi is going to go to $2.50, which was his price target. And then later on that year, he went on Yahoo Finance. He said SoFi is overvalued relative to Lending Club.
David, one of the trending tickers on our site over the last couple of days has been SoFi. KBW was out with a bearish call on the stock, saying that they think shares have risen a bit too far, too fast. I know you have a seller underperform rating on the stock. What do you see as a downside risk there for SoFi?
Yeah, so the main issue, at least in our mind with SoFi, is that they've grown very quickly over the past couple years. They did have a lot of capital coming out of their SPAC transaction. They acquired a bank, grew their loan portfolio very fast, but now they're bumping up against their balance sheet capacity since they put all that capital to work. So we're expecting net interest income growth to slow materially looking out to next year. And then with our base case scenario of expecting at least a mild recession in 2024, their credit costs for these consumer unsecured loans are likely to increase. So we think there's a kind of dual headwind with SoFi in that they've reached their balance sheet capacity and then credit costs could be on the rise looking out to 2024.
Now in 2024, he did update his price target to a whopping $3 per share, but he reiterated the bearish stance he had. And in fact, in December, when I talked about this pair trade, David Cavarini went on an interview and he talked about why he put on this trade, what his thesis was about this trade.
David, another name I want to get your take on, because you only have one underperform in your coverage universe, David. It's just one lonely cell sitting there, and that is SoFi, which has enjoyed, it's a nice move this year. It's up around 60%. Why do you remain bearish on SoFi, David?
Yeah, so SoFi, that's our paired trade with Lending Club, and Lending Club has actually outperformed SoFi when you look at the year-to-date figures. So when you look at the business model of SoFi versus Lending Club, they're actually quite similar in terms of the FICO range that they are targeting for borrowers, and the credit quality has been similar. But when you look at the valuation discrepancy between Lending Club and SoFi, it's too wide to ignore. So that's when I keep the underperform on SoFi and keep the outperform on Lending Club. But I'll give SoFi credit that they have been right in the sweet spot of this kind of fintech rebound that we've seen this year, and they've been benefiting. But if it weren't for their valuation discrepancy with Lending Club, we would be more favorable towards SoFi.
And as recently as March of 2025, just a couple of months ago, David Cavarini has left Wedbush. He joined Jefferies and he's no longer covering SoFi. And he didn't even make a retraction, honestly, on that trade that he made. Today, SoFi is trading above $13 a share, which is more than 4x his lowest price target. And I talked about this much more in depth in my December video, but in his pair trade, just to recap, he argued that Lending Club and SoFi have similar borrower profiles with regards to FICO, with regards to underwriting. Lending Club is therefore undervalued relative to SoFi. And as a result, SoFi is a better short and Lending Club is a better long. Now, if you're arguing that the businesses are similar, a spread trade doesn't really make sense unless you think something is broken in one of those businesses. The entire basis of his trade was valuation focused, and it was not fundamentally focused. He didn't flag SoFi as a deteriorating or unprofitable business. He didn't flag it as having macro specific risks that would crush the business. He ignored the fact that SoFi is not just a lender. He ignored the financial services, which is what we know now, growing at 101% year over year. He ignored largely the tech platform with Galileo and the API infrastructure that they have. And he ignored the massive deposit base. And what's more, he excluded their fastest growing segments from this equation. And as you can imagine, this went quite poorly because as of Q1 2025, when SoFi just reported earnings recently, they reported revenue up 20%. This was the same as Lending Club. Lending Club was also up 20% year over year for revenue for Q1. But what was different from Lending Club, fee-based revenue for SoFi was up 67%. The financial services segment was up triple digits. The loan platform business did $1.6 billion that were originated on behalf of third parties in Q1 alone, whereas Lending Club missed their EPS estimates and their originations are only up 21%. SoFi increased their guidance and Lending Club didn't update their guidance at all. SoFi didn't just grow faster, it showed that profitability across all three segments. It showed strong operating leverage. It raised their guidance. All the while, Lending Club, which coincidentally reported earnings on the exact same day, underwhelmed despite riding the same macro wave. Now, we just recently crossed the 2-year anniversary of this spread trade because David Chiaverini originally had this trade in May of 2023. And if somebody had followed that advice and put a long on Lending Club and a short on SoFi with the exact same amount of money in that time frame, they would have had drastic losses because not only is SoFi up, it's actually up higher than Lending Club year to date. And if you just zoom out and look in the past year, in the past 12 months alone, Lending Club is up 9%, whereas SoFi is up 89%. And so if you were long on Lending Club, yes, you would have made a little bit of money. But if you were short on SoFi, you would have gotten absolutely demolished with how SoFi has been performing over the past 2 years. Now, this trade fell apart because it was built on a narrow valuation-only lens with no appreciation for SoFi's long-term transformation and multi-segment growth. Since that time, SoFi has posted 6 straight quarters of profitability. They've scaled their fee-based revenue to over 40% of their total revenue. They've accelerated financial services adoption, and they've raised guidance yet again. And the reason why I wanted to make a video about this is because we're at that 2-year anniversary of this trade, and a lot can change in these businesses in 2 years. And it's very easy to see the cream rising to the top with businesses that execute. And all the while, today, 2 years later, the analyst behind this trade, David Chiaverini, is no longer with Wedbush. And so if you're wondering whether analysts can get it wrong, this might be one of the clearest cases that we've seen in fintech in the past couple of years. And it's also a reminder to invest in fundamentally sound businesses, in businesses that are growing and executing, because it's very easy to get bogged down in the nitty gritty of how the stock is performing on a week over week basis. But if you zoom out 1 year or if you zoom out 2 years, it's very easy to see, clear as day, businesses that are consistently executing, that have a better business model, that have a better management team. And it's very easy to see how you can get caught in this valuation trap by looking at these businesses that you think are similar and you're shorting one of those businesses. I remain bullish on SoFi. I think the Q1 earnings has reiterated that bullishness. I think the commentary from management on where they want to go has further reiterated that bullishness. And if you compare them to other peers, I remember a few years ago, SoFi and Lending Club were in the same sentence every single time they were mentioned on mainstream financial news outlets because they were seen as very close comparables. But I'm just going to put up this chart here that Chris has. You can see a clear breakaway from SoFi where they've decoupled from Lending Club. And I think this trade best illustrates that decoupling, and it best illustrates when a company is consistently executing the massive difference that it can make when you look on a multi-year time horizon. I hope this breakdown gave you some more clarity on SoFi. I hope it reinvigorated your bullishness for SoFi versus the Lending Club pair trade. I hope you didn't put on that pair trade because it also highlights the risk of blindly following these analysts. You would have lost money on this pair trade, and the analyst has moved on to a new job. They now work for Jefferies. Nothing really happens. There's no consequences for them going out and giving that financial advice. Always do your own homework when assessing these stocks and when investing your own money. And hopefully when you do your own homework, you're looking at business fundamentals and you're looking at that trajectory of growth and not only looking at very cherry-picked numbers. Thank you so much for watching, and I'll see you in the next one.